Good news or bad news first? And this is a question I always wonder, does anybody actually pick good news first, knowing that you're going to get hit in the head with the bad news after? Anyway, I digress. Let's get into the bad news, which I think makes the most amount of sense, and then we'll get into the good news after. So US market not doing so well. Obviously, the jobs report was disappointing, and the reason this is important I'll get to in a second, because it does have an impact right here on our real estate market. But ultimately, what is happening in the US right now is that jobs are weaker than expected, but one of the concerning metrics that we've seen in Canada that is now happening in the US is that the jobs that are being created are actually government jobs. Similar to the government bloat that we have here, a lot of government hiring that's happening. It's an indicator that the economy itself, the private sector that is not adding jobs, is struggling. So we don't have a lot of startups, we don't have people expanding. So that is the unfortunate thing. So not only are we getting job cuts, and now we're worried about the economy entering a recession, we're not getting the right types of jobs. And now for the good news, the Canada 5-year bond is now below 3%, and it dropped sharply after the US jobs report came out. So for those of you renewing at the tail end of 2024 and 2025, which is I think a bulk of the mortgages that are actually coming up for renewal, you can breathe a sigh of relief that you're not going to be renewing at 6% like some of us had to. So you're probably going to be looking at mortgage rates somewhere in the 4s. Who knows, depending if you're insured, uninsured in the terms of your mortgages. So this is the good news. Before getting into the actual Toronto real estate numbers, I do want to highlight this video done by the CBC. It's a really good video that pulls together the reality of how Canadians are feeling about the economy versus what the metrics are telling us and how the economy is apparently pretty decent. And shout out to my friends at the Canadian Real Estate Show that sent me this video. So ultimately, as you'll see right here, the punchline is Canada's GDP growth is fairly decent relative to its peers, but when you break it down on a per capita growth, we're actually dead last, and by a big margin. Canada has propped up its numbers via, let's call it irresponsible immigration, where we brought in a ton of people in a very short period of time, which is what's propping up our numbers. If you strip that out and we actually had the regular immigration numbers that we usually would have, Canada would probably be last here on all GDP metrics as far as the economy is concerned. I will put this video in the description below, so please watch it if you want to educate yourself. They've kept it very simple. Even somebody like me could understand it, so I'm sure you'll be able to understand it too. So let's get into the actual numbers. All right, the July price decline for the GTA is pretty spectacular. We went from a 9% year-to-date gain to now 4.64. So ultimately, we are most likely going to wipe out any price increases that happen in 2024. At least that's my expectation by the end of this year. I called it earlier. 2023 was a flat year. 2024 is most likely to end up as a flat year as well. But here are some interesting stats. Typically in the summer months, seasonally, we lose about 5% of appreciation. So let's say we go up 13% year to date in a normal year, quote unquote normal year. Then we'll drop about 5% over 3 months. We dropped 4.5% just in 1 month. And this is likely going to continue into August, as a lot of sellers, I think, are capitulating to the price pressures. There's very little activity right now. That in September, this is going to level off, and we're probably going to have a short-term blip where prices are probably going to go up. Seasonally, this happens even in a downward trending market. I do expect, however, October, November to look very similar to our summer months, where we're not going to see the gains that we're seasonally seeing. We're probably going to enter the winter market earlier. And that is despite how many more rate cuts we have, unless there's substantial, so to the tune of 50 basis points or more. Here's an interesting stat, and this is where things are getting a little bit interesting. So new listings continue to be above seasonal norms, but at the very least, they're actually in trend and they're going down. But as you can see, there's a divergence. They're not going down or decreasing as fast as they should be. So meaning we're most likely going to have more and more active inventory going into the future months. This is not the biggest concern. The biggest concern continues to be right here, and this is the lack of buyers or lack of transactions that are happening right now. So if we typically have 8,500 sales in a slow summer month or in a seasonal summer month, we're currently at 5,300 transactions. In other words, the market right now, we have 40% less buyers, and it's actually much worse on when we're talking about condos or less desirable properties. You have maybe 60 to 80% less buyers than you typically do. And this trend does not seem to be improving. 2 rate cuts. I know people think that with more rate cuts, the buyers are going to come back out. I am very reluctant to believe that's going to happen unless the rate cuts are substantial. I'm talking 50 basis points or more going forward. Now let's put things into perspective. The only other time we can really look at to compare in terms of a recession is the 2008 financial crisis. So new listings in July of 2008 were at about 15,000. Now in 2024, we're above that. We have actually 16,000 or 16,300 listings relative to the 15,000 that we would have had in a bad economy in 2008. But despite the economy being bad, back in 2008, in this exact same month, they actually had 7,800 deals happen. So they still had buyers, whereas right now we don't have buyers. In fact, we have never had a market this slow in the last 16 to 17 years. The only other time when we've had 5,300 transactions happen in a summer month like this was back in 2023, which was just last year, which was one of the record-setting years in terms of the lowest deal flow on record, I think, in the last 20 years or so. This can be explained by very simple things. We have had interest rates rip through the roof, and yet prices have remained very sticky, and we haven't seen much in the way of price decline in the last little bit. So prices are usually very sticky on the way down, and I think we're going to start seeing some movement there because this is unsustainable. Sellers will not be able to hang on indefinitely when we're working with 40 to 50% less buyers. Now, because real estate investing and speculating in the GTA is somewhat of our regional sport, probably the number one sport, I do want to highlight two examples of properties that are starting to pencil and make a lot of sense to me anyway. I'm not saying or endorsing these or to go buy them or they're good deals, but I do want to show you the math. This is a studio that sold for $350,000 in the downtown core. The carrying cost for this with 20% down, maintenance fees, property tax, and everything is about $2,100. The rent that something like this brings in is about $1,800 to $1,900. So your cash flow negative about $200 to $300 per month. These are numbers that are unheard of. In the past, people were buying condos with $500, $600, $700 cash flow negative because when rates were low, a lot of the rent was actually going down into principal repayment, not interest, and therefore it made sense even if they were cash flow negative. But for me to see deals like this that are starting to pencil or be cash flow neutral, it's very interesting. So something to keep an eye out, especially in the condo space where you're seeing a lot of supply and not much demand. I think this is where you're actually going to find the best deals over the next 6 months. Now, here's another one that is not condo based. This is a detached property close to downtown in the 416. I showed this property. There are 3 self-contained units here. Asking price is 1.1 million. Can probably get it for a little bit less. The math here is very compelling. You can get this with 20% down. Your mortgage is going to be, call it $4,800, maybe less, depending on your situation. And the potential rental income out of this place right now based on market rents is about $7,000. So your mortgages, call it under 5, and the rents you're getting is 7,000, which gives you a lot of money for maintenance, property tax, upkeep, and all the other stuff. So very interesting. Things are starting to make a lot of sense. It was very hard to find things like this in the past that made sense. Now they're starting to make sense. So I'm wondering how long until people start jumping at these opportunities. Again, this is not to say this is the time to jump, but it's starting to pencil, and when it starts to pencil, usually the smart money starts following. Last but not least are active listings, and as you can see right now, this number continues to grow and it's at 23,800 listings. We're supposed to be trending down right now in terms of active listings, but we're not, and that is because obviously things are not selling and sellers have to continue to relist while new listings are coming on, and this is how you create this pile up of inventory. Now, obviously this is for the entire market, GTA as a whole, but it's very much dependent on where you live, the type of property. So this is not necessarily the case for everybody. Certain properties still do sell, and not everybody is seeing massive amounts of inventory in their specific neighborhoods. That's the key thing to remember, but directionally, this is what the market's doing. One thing to highlight is, while seasonally we are higher than we're supposed to be, in 2008 during the financial crisis, this 23,000 was actually over here at about 26,000 active listings during the financial crisis. So we're still better than that. Can we get to that number? Maybe. Are we going to get there? I don't know. Things are obviously very dynamic as we speak right now. We'll find out what happens next month, and I'll see you in the next one.